Hello, welcome to Accounting 2010 Chapter 3 videos. Video 2, Adjusting Entries. How is it done? As I mentioned in video 1, we are going to be returning back to Road Runners Roost, the company we talked about in Chapter 2. And again, this goes to, we've just completed Principles Accounting 2010 at MSU Denver, and we are starting our own um, tutoring business. So when we left off in Chapter 2, we left off on the 4th of July, which is kind of funny, and we all jump for chapter 3 up to the 15th of July. Now these are going to be regular journal entries that we're going to be creating before we get into the adjusting entries, but I want to add a few more transactions to our business. So in the first case, we are going to, on the 15th, purchase $8,000 worth of furniture from American Furniture, and you estimate that the furniture will last you 5 years and have a residual value of $500. And so it's going to be very important data for us to look at how we are going to be using this to record that the fact that our furniture does wear out over time. So we say that it will last us 5 years, worth $8,000 and a residual value. We'll talk about this in a bit. On the 23rd, we land our first customers. And this is a group of new 2010 students, and they are going to give us or prepay us $1,000 each. There are 4 of them, and they are going to give us $1,000 each, and they will begin their tutoring in mid-August and in mid-December. And we know from Chapter 2 that when somebody gives us money in advance for work that we have not earned, we call this what? An unearned revenue. So we'll be recording that as well. And the 24th, we go out and we buy another $600 worth of supplies, and we're going to be addressing this coming up. And then on the 30th, the athletic department stops by and they give us $6,000 to get everybody caught up on 2010 materials before they start 2020 to make sure that those student athletes have a good head start. So they say, come on down, we want to train our student athletes right now. And so we're going to earn that money on the 30th of July. So what would this look like in the form of journal entries? So in the form of journal entries, the first one we had the furniture, and we had charged the furniture into a notes payable $8,000. Debit to the asset, it goes up. Credit to the liability, it also goes up. And you can be using your sheets, your debit credit sheets to see how this works. On the 22nd, we stated that we had some students come in and prepay us, give us in advance money for tutoring services in the future. We got the cash, asset cash went up, debit. However, we have not earned the money, therefore, until we earn it, it is a liability, it's an unearned revenue. The credit goes to the liability, it also goes up. On the 24th, we bought some supplies, $600 worth of supplies, and we used cash to pay for them. Asset supplies goes up, asset cash goes down, debit to supplies, credit to cash. On the 30th, we received $6,000 cash to provide tutoring services for the athletes at MSU Denver, and we did the work right then and there that day so we could record it as tutoring revenue. So with that, you can see that I've actually posted those all into the ledger as we had learned in the previous chapter, and here they are. But now we need to jump into adjusting entries. And what are adjusting entries? Well, adjusting entries are going to be entries which we are going to be making at the end of the month that will describe events or transactions that have happened in the business that we have not yet recorded. So how can we do that? Well, your book is going to give you specific situations, and they will be practiced in class as well and in your assignments. But another way to do it is to go ahead and let's take a look at that sheet that we talked about in the previous video, the types of adjusting entries, the prepaid expenses, the unearned revenues, the accrued expenses, accrued revenues, and let's discuss another method which we can use, which is used in real life. So in real life, you're going to have your unadjusted trial balance, and you use this on your first exam. And the unadjusted trial balance means that this was created before adjustments. And in real life, we would never prepare financial statements on an unadjusted trial balance. We would prepare them on an adjusted trial balance, because that would give us the proper reflection of what's really going on in our business. So prior to making adjustments, we had given the journal entries I just created and posting them to the ledger. This, these are the balances in each of these accounts. We have 14,600 in cash and so on. Now, how do I know where to make adjustments? Well, if you go down the list, and the first thing we're going to look at are prepaid expenses. So what would be prepaid expenses? We haven't really heard that before. Well, prepaid expenses are, in a sense, prepaid assets that, when they are used up, become expenses. What do I mean? Supplies. When we buy supplies, supplies are an asset until we use them up. When we use them up, they become an expense. So at the end of the month, we're going to go ahead and we're going to go look in our supply cabinet and see how much do we have left in supplies. Well, if we went to the supply cabinet and we saw that there were $400 left in supplies, how much in supplies did we use up? $800. So if we had $1,200 worth of supplies we had purchased, we had $400 remaining. That means we used up $800. What would be the journal entry? Well, let's go ahead and look at this, the general journal. And if I scroll down, you will see adjustments on the 31st of July. I'm going to record that we now have those supplies became an expense of doing business, $800. We're going to remove them from supplies, $800. Let's see what that would look like in the ledger. So there you have, we had bought 600 of supplies on the 15th, or excuse me, the 2nd, another $600 worth of supplies on the 24th. We record on the credit side to show that it is decreasing on an asset. Debits show an increase, credits show a decrease. 600 plus 600, 800 of decrease gave you a $400 balance. The corresponding entry will show that the amount of your supplies expenses go up on what side? The debit side. It will show the supplies expense increasing by $800. Let's go ahead and look at the next one. So prepaid insurance. Prepaid insurance is an asset. Once we begin to use it up, it becomes an expense. So we had purchased 12 months worth of insurance, and 12 months worth of insurance, when we paid $1,200, is how much per month? $100. So now we can go ahead and write the journal entry that says we used up $100, and we've got it down here, $100 of our insurance expense. $100 became an insurance expense, and it'll show that we have used $100. In the ledger, how would it look when posted? We had $1,200. We used up $100 one month, leaves us a balance of $1,100. The expense, the corresponding expense, we can have and show that $100 of insurance expense, an increase in expenses of $100 for that month. Let's look at the next one. Prepaid rent. We have prepaid 3 months worth of rent. 3 goes into $3,600, $1,200 a month. We used it up by the end of July, 1 month. What does the journal entry look like? Now some of that prepaid rent becomes a rent expense for the month, $1,200. We've just now reduced our prepaid rent, the asset, by $1,200. Let's go ahead and look at that. We had the prepaid rent right here, $3,600. We've reduced it by $1,200, leaves us a balance of $2,400. Debits increases on, assets increase on the debit side, decrease on the credit side. And now we show the increase in rent expense on the debit side. We've got a $1,200 increase in rent expense. The next one down the list. All right, now we're getting into a new issue, computers. Another asset. Computers are an asset. We can call them plant assets or long-lived assets. And when we have an asset that will last us more than 1 year, we need to take into account that it's wearing out. How do we do that? We call it depreciation. Depreciation is an expense that has occurred that we need to keep track of. And so what we do, had the data on the computers that we had. The computers were $5,000, and they had a life of 36 months, gave us $139 a month that we're going to say that they are going to be wearing out. Now this might not be actually true of the value of how fast they're wearing out, but this is the cost allocation. We're allocating the cost of the period of the computers over the life of the computers. So we say that those computers are wearing out at a rate of $139 a month. How do we record that? Well, we've got a couple of new accounts. One, we've got a depreciation expense. That's going to show us the expense that those computers are wearing out, or our estimate of their the use of those computers, $139. Then we're going to have a new account, and we call this accumulated depreciation. And this account is going to keep track of how much depreciation expense has accumulated over time. This is going to be an account that will grow and grow and grow. And we call this a contra asset because its balance is going to be contrary to the asset account. Computers, it's going to be a subtraction. So I'm going to show you in the ledger what this looks like. So we have the depreciation expense computer. It shows the expense just for this period, and we'll be talking about that in Chapter 4. And we also have the credit to the accumulated depreciation account computers. If you can see, it's right there. And the accumulated depreciation account is going to follow its asset account. This is a contra asset. This is the asset. It's going to follow its asset account like a little nagging sibling. It's going to be joined at the hip and it will not let go. And it's going to grow month by month. So in month 1 it'd be 139. In month 2 we could take that 139 times 2 and it would have a 278, and so on and so on. And it's going to be attached to show how this account is decreasing, and I will be showing you that in Chapter 4. So let's go on to the next account. We've got furniture. It's going to be treated exactly the way computers were. It's a long-lived or a plant asset. It will last us more than a year. So we're going to depreciate it, spread out that cost over time. The problem said that the furniture had a value of $8,000, and we thought at the end of its life we might be able to sell it and get $500. If an asset has a salvage value, or an amount we think we can get out of it at the end of the time we're done with it, we need to subtract that out and then divide by the life of the asset, the estimated life to us, and give us a per month depreciation rate. This is called the straight line rate. In Chapter 9, I believe it's Chapter 9, we'll be covering this in depth. So in the case of the furniture, we have $125 per month. We're going to go ahead and record in our general journal $125 per month depreciation expense, and then the accumulated depreciation $125. If we post those in the ledger, we show that the depreciation expense for the furniture, the accumulated depreciation for the furniture, again, contra asset to the asset, tied at the hip, we'll follow it around. So after 1 month, what would we say that the furniture value is as far as an asset? Well, we would take 8,000 minus 125, and now the furniture has a carrying value or book value of 7,875. The 8,000 minus the 125. The same thing would be the computers. The computers would have a carrying or book value of 5,000 minus the 139. And we'll see what that looks like in just a bit. Let's go back to the unadjusted trial balance. And let's see if any of these other accounts need adjusting. Well, let's see. We're going to delete this. That isn't relevant. Did we pay any money on the accounts payable? No. Had we earned any of the revenue? Well, we'd have to look. Do you see this unearned revenue? Did we earn any? No. The problem said that we would be earning it from the middle of August until the middle of December. We had not made any payments on our notes payable. We had not had anything else happen. So this gives you an idea of the type of adjusting entries that we would make. And we will be going through this in class, and you'll see lots of examples in your homework. Once we've made and posted all of those adjusting entries, and that has been done for you, we can go ahead and prepare the adjusted trial balance. And this trial balance is going to show all those adjustments that we made. There will be a number of new accounts added, all of those expense accounts, accumulated appreciation. And you see how I have it attached to the computer? I have the furniture attached to the furniture. It is from this adjusted trial balance that we will prepare the financial statements. Please note that the total debits do equal the credits at the point that we have prepared the adjusted trial balance. If they had not, we would have done something wrong. In Chapter 4, we're going to finish up the accounting cycle. We've already covered the first several steps: the analyzing, the journalizing, posting, the unadjusted trial balance, the adjustments, which then have to be journalized and posted, and at this point that we truly are ready to make the 3 financial statements that we are studying in this class.